Welcome, everyone. I'm excited to be here with you today. We're about to dive into a fascinating topic, the liquidity sweep strategy explained. This presentation is brought to you by Software STC Market Bull, focusing on smart money CONCPTS. Over the next few slides, we'll explore how this strategy works and how it can help you improve your trading. So, let's get started and make the most of this session. Let's talk about breakout entries. Retail traders often create these by making predictions about where the price might go, expecting a breakout. However, it's important to understand that institutions can see these setups and may exploit them during liquidity sweeps to make a profit. Next, providing liquidity is a key concept. Retail traders contribute to this liquidity mainly through their stop-loss orders. When many traders place stop-losses at similar levels, it creates a pool of liquidity that institutions can target to execute their trades more efficiently. Moving on to volume requirements, institutions operate with large amounts of capital. To build or close significant positions profitably, they need substantial market volume. This means their trades tend to be larger, which can influence overall market movements and create opportunities for savvy traders to understand the bigger picture. Finally, understanding the dynamics between institutions and retail traders is crucial. Institutions often look for areas where retail activity creates predictable patterns, like breakout points or liquidity pools, so they can capitalize on those movements. Recognizing these behaviors helps us better interpret market actions and align our strategies accordingly. Let's talk about stop-loss placement. Traders often set their stop losses at recent highs or lows, which might seem logical at first. However, this practice can inadvertently create liquidity pools, areas where a lot of orders cluster, making it easier for smart money to target those zones. Understanding this helps us see how the market can be manipulated and why certain levels attract so much attention. Now, moving on to breakdown selling. Many retail traders tend to sell when prices break below established lows. It's usually driven by fear, fearing further declines and wanting to protect their investments from bigger losses. But this reaction can sometimes play right into the hands of more experienced traders who might be looking to capitalize on these moves. On the flip side, there's breakout buying. Retail traders often jump in and buy when prices surpass previous highs. They see this as a sign of a strong upward trend and believe their investments will continue to grow. While this can fuel momentum, it's important to remember that not every breakout is genuine. Sometimes they're just fake outs designed to trap retail traders. Finally, understanding retail trader behaviors and reactions is crucial. Their psychology, fear, greed, and herd mentality drives many of their decisions. Recognizing these patterns helps us anticipate market moves and develop smarter trading strategies. When we understand how retail traders react, we can better position ourselves to exploit or avoid their traps, aligning our approach with the overall theme of smart money strategies. Let's take a closer look at what a buy-side sweep really means. Essentially, it happens when the price reaches those equal highs we've been watching. At this point, buy-stop orders are triggered. Those are orders placed just above the recent high, waiting to be executed once the price nudges higher. When these stops get hit, it can cause a sudden surge of buying activity. But here's the interesting part. This move often tricks the market into thinking there's strong buying momentum. In reality, what's happening is that big institutions may be using this as a setup to enter sell positions. So, after the buy stops are triggered and the price seems to break higher, the institutions can then push the market down, leading to a strong bearish move. This is a classic example of a market trap, where what looks like a bullish breakout actually sets the stage for a powerful reversal. Understanding these moves helps us see through the noise and anticipate potential traps before they fully develop. In a buy-side sweep, what happens is that prices often spike above those equal highs. This triggers buy stops, which are basically orders placed just above previous highs, waiting to be hit. When these stops get triggered, it can lead to a quick move in the market. But what's really important here is that this sudden spike often results in an immediate price rejection. The market quickly reverses, showing that what looked like a breakout was actually deceptive. This kind of move highlights the tricky nature of breakouts and why it's so important to be cautious. Understanding these fake breakouts is key to avoiding false signals and making smarter trading decisions. So, when we see a buy-side sweep like this, it's a warning sign that the breakout might not be as solid as it appears. Let's talk about a sell-side sweep. This happens when price targets hit lows that traders have set, which can trigger sell stops. And what does that mean? Well, it often allows institutional traders to step in and buy in at these lower levels. Essentially, they're taking advantage of that liquidity to enter buy positions quietly. This activity can lead to a potential bullish move afterward, as the institutions accumulate. It's a key concept because it shows how understanding these market behaviors can give us clues about future price direction. Recognizing a sell-side sweep helps us identify when the market might reverse or gain momentum, which ties directly into our broader theme of understanding market reversals. In this scenario, what we're seeing is the market forming equal lows, which can often entice retail buyers into thinking that the support level is solid. When traders spot these equal lows, they might assume the downtrend is about to continue, so they look for opportunities to buy. However, what happens next is quite interesting. A sharp price drop occurs, breaking below those lows. This sudden move catches many off guard. But then, surprisingly, the market turns around and makes a strong bullish reversal. This is a classic example of how deceptive the breakdown can be. It might look like the market is heading lower, but in reality, it's just a setup for a bullish rally. This kind of move highlights a key concept in understanding market dynamics, that what appears to be a breakdown or a continuation can sometimes be a fake-out designed to trap traders. Recognizing these patterns is crucial for developing a solid trading strategy. And in this presentation, we're focusing on understanding these market behaviors to better anticipate and react to such deceptive moves. Now, let's take a closer look at understanding the differences between key market movements. First up, we have the liquidity sweep versus breakout. A liquidity sweep often looks like a quick, sharp move that taps into pending orders or stop-loss levels, and it's usually followed by a rapid price spike. This spike can give the illusion of a breakout, but it's often a false signal, trapping retail traders into losing positions when the price quickly reverses. On the other hand, a genuine breakout involves more than just a quick move through a level. It typically includes a retest and holding of previous support or resistance levels. This retest is crucial because it indicates a structural shift in the market, showing that the new level is being accepted by price, and suggests a higher probability of the trend continuing in that direction. Now let's talk about the fast spike. This is a classic characteristic of a liquidity sweep. You see a rapid, almost impulsive spike in price, which is then immediately rejected. It's like the market is testing liquidity, but it's not a true breakout. Instead, it's a false move designed to trap traders who jump in too early, thinking the trend has changed. So, understanding these differences helps us avoid false signals and better interpret market actions. Recognizing a retest and holding as a sign of a real breakout versus a quick spike and rejection can make a big difference in our trading decisions. Now, let's talk about entry points. One of the most reliable ways to improve our chances of a successful trade is by entering at order blocks or fair value gaps, often abbreviated as FVG. These areas tend to offer optimal market conditions for execution because they reflect strong institutional activity or imbalances that price is likely to revisit. Next, we have the concept of a change of character. This is a crucial signal because it indicates a shift in the market structure. When we spot a change of character, it often confirms a reversal point, giving us increased confidence that the trend may be about to turn. This makes our trades more reliable, especially when we combine this with other signals. Then there's liquidity sweeps. These are significant because they reveal where institutional traders are positioning themselves, targeting key market levels to maximize their entry and exit points. Recognizing these sweeps can give us insight into the larger market moves and help us align our entries accordingly. Now, what happens when we combine liquidity sweeps with a change of character? This combination forms an advanced setup that can significantly enhance our trading edge. When a liquidity sweep occurs at a point where a change of character is identified, it suggests a high probability reversal or continuation scenario, because institutions are actively positioning themselves at strategic levels. Putting it all together, understanding these entry techniques and how they interact allows us to better navigate the market's complexities and make more informed, strategic decisions. Now, let's take a closer look at the sell entry concept. A sell entry is typically positioned at a premium zone, which is an area where we expect the market to have accumulated sell-side liquidity. By targeting this zone, we're aiming to capitalize on the optimal risk-reward scenario, because it allows us to enter trades where the potential profit outweighs the risk involved. Next, we see the importance of the CHoCH, or change of character, which is confirmed after a liquidity sweep. This signals a shift in market momentum and direction, indicating that the previous trend might be revering or at least pausing. Recognizing this change is crucial because it helps us time our entries more accurately and avoid false signals. Then, we consider the liquidity taken stage. This is where the model really kicks in. It's when buy-side liquidity is absorbed, meaning institutions are stepping into sell positions to lock in profits or to push the market in a desired direction. This liquidity absorption often precedes a move down, making it a key point for traders looking to enter short positions. Finally, understanding this process is essential for developing an effective market entry strategy, especially within the bearish trade model. By analyzing how liquidity is taken and how CHoCH confirms the shift, we can position ourselves advantageously in the market, aligning our trades with the institutional flow to improve our chances of success.